So my name's Shelley Lotz, and I head up Regulatory Affairs and Policy at Savca, and I'm also acting CEO at the moment. So it's my privilege to welcome you to the 2022 Savca Private Equity Survey launch in partnership with EY. I think, firstly, I'd like to say thank you to all the members that actually participated in the survey and actually gave up their time to fill in the very long survey. Sorry, EY. In my day job and actually dealing with both policymakers as well as capital seekers or capital allocators, we really use this information quite a lot to tell the private equity story. Where are we going and where's the capital being invested? And it is really, really important. I can't tell you how many times we actually show the graphs and really tell the story about what private equity is trying to do and why more capital needs to flow there. In terms of your CPD, which everybody always asks for, so make sure you've signed, and then we will allocate the 1.5 CPD points, and you'll get certificates after the event. The agenda for today, so the welcome and introductions is me. We'll then go on to the survey highlights and the methodology. We then are lucky enough to have an economic overview to really just set the scene before we go on to a panel that's actually going to talk about their experiences as it relates to the survey results and what they saw in the calendar year 2021. So as I said, that's me. The survey findings, it's Gagana Ivanova. I practiced it last time because I messed it up at the foundation phase. She's an associate director at EY. And then Angelica Goliger is going to talk, and she's the chief economist from EY Africa, and she's going to give us that economic overview. And then last but not least, Graham Stoker, and he's the private capital lead at EY, is going to moderate the panel. And we've got a nice diverse group of panelists from different fund managers in the industry that are really going to talk through their experiences in 2021 and the types of things that came out of the survey. So for those of you that didn't get it, the survey, it was actually at the entrance when you collected your name tags, but it'll still be there afterwards. It'll also be on our website if you don't want a printed copy, but there are some printed copies there. So, Gagana, I will pass on to you.
Great. Good evening, everyone, and welcome. Very glad to have everyone back in person. I believe this is the first one that we're doing back from the virtual live of the last 2 years. So it's really great to be able to see everyone in face-to-face, and then obviously to have a bit of networking and drinks afterwards on the Sky Deck. So before we get into some of the highlights from the survey, I do want to talk about the methodology very briefly. But just bear in mind that there's quite a lot in that survey that we've tried to pack in. It's the long survey everyone had to deal with. So I'm going to just focus on a couple of key things that we want to flag. And then obviously you can have a look at the detail in the printed or the digital versions. So in terms of the survey, we had 40 respondents this year, and it was across both captives and independent funds. Now, in some cases, some of the respondents had multiple funds that fit under the actual firm that had responded. And it covers the calendar year up to the end of 31 December 2021. And what we've actually tried to do throughout the survey is include comparisons to the global sector and try and see how the local landscape in Southern Africa compares to the global private equity sector. And that is based on the EY Global Survey, which covers the same period and was published earlier in the calendar year. There's quite a lot of things around strategic priorities, ESG, impact investing, talent, BE, and then we get into the hard numbers around funds under management, investments, fundraising, exits. So we've tried to kind of get a cross-section in the highlights from all the bits and pieces, and then there's a lot more in the actual survey. So EY was responsible for the research and the analysis, and then the Savca team did a lot of the reviews and looked at the aggregated data and the aggregated information that comes out of the survey. So with that, let's get into some of the highlights. The next slide, which we'll get up shortly, is around the top strategic priorities other than asset growth. And what we found interesting is that those top 3 priorities were actually aligned between the local participants in Southern Africa as well as the global survey. Those were the product and strategy expansion, ESG, initiatives, and then talent management. In Southern Africa, it was really the product and strategy that was ranked highest. But when we look at the global survey, it was actually talent management which ranked the highest. And I think that has to do a lot with the great resignation that I think the whole world really went through over the last 12 to 18 months. The next slide is really around the diversification of products that a lot of the participants in the private equity sector are offering. And what we saw globally and in Southern Africa, it was really the private credit that ranks highest consistently. And then real estate, fund of funds, venture capital, and real assets are the other sort of popular diversification strategies. The next section that we wanted to get into briefly is ESG. And obviously ESG is really picking up momentum in terms of how topical it is, both in Southern Africa and globally. The one thing that's quite interesting that we've noted through the survey, and this is obviously covering the 21 calendar year, I think there's further momentum that we're now seeing in 2022, is when we look at the Southern African participants, the ESG risks and opportunities are considered very seriously. And a lot of the participants noted mature ESG policies that are being implemented. A lot of that has to do with the DFIs who are quite consistent investors in Southern Africa, as well as the rest of the continent. But if we look at the global respondents, they actually noted that ESG risks are actually considered more on an ad hoc basis. And on a global perspective, the investment returns are still really the most kind of overriding consideration when it comes to the consideration in investment decisions. Now, this is quite a busy chart. I think there's a lot going on, and you can obviously have a look at it at your leisure in the report itself. But the two things, speaking to the previous slide, that we wanted to pick up on is specific impact investing mandates. And what we see is majority of the funds don't actually have specific mandates yet. However, a large number do, 45%. And then if we look at the last sort of bar, the 86%, that is the funds that are considering actually implementing impact investing mandates over the next 5 years. And we can see that that's quite a large proportion. So over the next 5 years, that kind of dynamic between the 45 and the 55 is likely to start shifting. Okay, great. The next topic is around talent. Obviously, it's a very important topic, as we saw from the strategic priorities globally. Talent management really ranked the highest. And when it comes to talent management, we asked the respondents, what are the priorities? What are the most important things that you consider? And consistently across the global and the Southern African respondents, it's really the hiring and onboarding of talent which ranked highest. We can see there with the 61%. And once again, that I think speaks to some of the challenges around attracting and retaining talent and the kind of the great resignation wave that we saw over the past sort of 12 to 18 months. The next highest one is the diversity, equity, and inclusion. And then we're going to move into the next slide to see what that looks like. The following slide will show what that looks like and the breakdown of the actual proportion of how transformation is taking place across the industry. But before that, hiring and onboarding of talent is obviously one of the key priorities for respondents. So we wanted to figure out, within that, what are you focusing on and what is most important? And here we had increasing gender representation being the highest contributor. And once again, this was fairly consistent between Southern African and global respondents. And that really speaks to the transformation of the industry. There's been good progress that's being made, but there's more work to be made. Hence that featuring quite highly on the survey. And I think what you'll see in the actual survey itself is a lot of the statistics around front office, back office, and how the representation is split out, and what the progress is from some of the previous surveys and respondents. Okay, here we've got the distribution of the actual participants and the employees by race. And what we can see is within the Southern African context, there's been a lot of progress from transformation. And we've got African and Indian groups featuring highly. And this is something that's quite high on the priority for the global private equity sector as well. And Southern Africa is actually making quite a lot more progress in that space. Once again, obviously more work to be done, but I think these are great statistics that we can show. And then we'll see a little bit later on the actual B ratings of the various funds, and we'll see that there's great progress happening in that space as well. Okay, so I think these were more the kind of strategic highlights that we wanted to pull out. And the next thing that we want to present is some of the numbers. I know that everyone is here for the numbers, and that's the most important thing, other than the drinks. I think Skydeck's priority, and we've got the numbers next. So we want to start with funds raised. So let me start with the negative and then the positive. Fundraising has come off a little bit from the 2020 results, about a 4% decrease. However, that is in line with what we're seeing globally. So globally, we did also see a decrease in the fundraising, about 3.5%. So that is really on par. And then if we had to look at the history over the last 11 years that we've presented of the survey results, as much as 2021 is a little bit coming off a little bit on 2020, it's actually not too bad when you look at the kind of greater trend, and we're still doing much better when it comes to fundraising. I think there's more that can be done, and I think as we get into the exits and we look at unrealized investments, we can see where we can probably do a lot more work to actually unlock further fundraising. Okay, with that, we want to look at the number and the cost of investments. And once again, a bit of a mixed bag here, because we've seen the actual number of investments dipping in 2022. The value is up a little bit, but fairly consistent with 2020. And that is really tied into the fundraising. Obviously, you need to drive fundraising to then be able to also drive further investments. And it's also doing with increased competition in the space, because we've got new funds coming up. We'll explore a little bit what the exits look like and what secondary space looks like. And that's where there could be a lot more work done in terms of increasing investments. But that being said, if we look at the longer term trend, there was obviously high level of activity in 2017 to 2019, and that's come off. And I think this is going to link nicely to the exit story, where we're going to see a lot of kind of exits of investments that were done over those periods that are now coming up for exit, and where that can unlock further fundraising and further investment. Okay, so this is it's not my favorite chart because it doesn't look great in terms of the trend, but I guess it's really one of the things that I'm most passionate about. And I think the reality of what we're seeing here is a continued trend of decrease in funds returned to investors. Now, there's a number of ways that this can happen, but exits is obviously the predominant way in which you return funds to investors, and we're seeing a continued decline there. Now, there's obviously a lot of reasons behind it, but from our experience with working a lot with private equities, a lot of it has to do with the preparation of the portfolio companies for exit, to make sure that once you're in the process, you're well prepared and you don't have things that can trip things up. You know, obviously getting alignment between buyers and sellers, negotiating price, those are things that are always going to be there, but preparing well for that can actually help expedite that process and actually land a successful deal. So one of the things that we often see is considering the buyer universe early on, and really kind of deliberately thinking about who are the likely buyers, and preparing equity stories for those buyers. And sometimes that means certain things need to be fixed up. You know, is it cleaning up the accounts? Is it improving IT? Is it improving operations? Is it tracking KPIs a little bit better? Depending on who your actual ultimate buyer is, if it's a strategic, a listed, a financial buyer, there may be different things that someone needs to focus on. And that's really one area where there could be further improvement to actually drive the successful exits. And hopefully we can see an upward trend in this chart in the next survey next year. The other thing is the macro environment. You know, the macro environment is very challenging. And what we're seeing is reduced buyer universe, because there are a lot of international strategics, which you really want to get in the mix for the larger assets. And given the macro environment, it's quite difficult to get some of those buyers over the line and into the processes. So that's really the key message for us. It's looking at that buyer universe, trying to make sure that you prepare the actual assets and portfolio companies for exit. And And then hopefully that helps to get to the right value when you're actually doing the exit. And then we see this funds return to investors trending upwards. And that is quite an important story around, driving investment in Southern Africa, especially from international investors. And being able to start realizing more value and returning funds is really something that can help the actual fundraising process, which kind of ties back to what we saw with the fundraising being a little bit off from prior years as well. Okay, so linked to exits, there's a little bit of a positive story. So we see the number of exits actually doubling from what we saw in 2020. But so there has been some bounce back in terms of the exit activity, and some of it has to do with a bit of a backlog from 2020, where a lot of exits didn't actually end up being realized in the sort of throes of COVID. But once again, we're seeing lack of those big ticket exits and big ticket deals, which is why even though the number has actually doubled, the value has trended downwards. And the other thing is, if we contextualize with what's happened globally, which is what we've tried to do throughout the survey, globally there was a record level of activity when it comes to exits, and we're not seeing that in the Southern African context. So it really feels like this is the area we can do more work to actually kind of boost the performance of the industry locally. Okay, great. So next one is funds under management. This is a combination of the undrawn commitments and the unrealized investments. Majority of it is driven by unrealized investments, which once again I think speaks to some of those exits that are pending, that are hopefully going to materialize over the next 18 months. And the positive here is that there is dry powder to deploy, and hopefully in future years we can see a little bit of a switch between the dry powder at the bottom and the actual unrealized investments that we see at the top. That being said, just bear in mind that these investments are at cost. Some funds obviously do it at fair value, but we've tried to keep it consistent across various funds that actually take part in the survey, and it's presented at cost. Okay, great. And last but not least, we wanted to look at a little bit around the BE rating of the fund managers. And this is an area where we feel like there's great progress that's being made. A lot of work still to be done, but if we look at our level 1 fund managers that take part in the survey, there's been a marked increase for 3 years running now, and the numbers are starting to become more meaningful, and we're hoping to continue seeing a lot more increase in these proportions and percentages, as obviously the sector is maturing, and obviously as we're seeing more transformation in the sector. Great, so that is all that we wanted to share with you. A lot more that you can enjoy in the survey itself. Do we have time for a few questions? You can repeat the question. I think it's quite a small room. It's the proportion of new managers, yeah?
Yeah, compared to, yeah.
So it's not, to be honest, it's not a metric that we specifically track, but what we're seeing in terms of the respondents, and look, the respondents do vary year on year, because you get the same sample that the survey goes out to, but depending on who responds, it's not necessarily the same respondents each year. But we are seeing a lot more newer funds coming through, and new members that are joining Savca that end up taking part in the survey. So it's definitely an increasing proportion, but I don't think we've got the firm numbers around that.
Of the 40, I think it was about 3 or 4, and maybe that's an advert to new managers who didn't participate. It would be really fantastic to have your inputs for next year, because, we were a few, but I think there are many more new managers out there, and it would be great to have you participating as well, and showing even more transformation than the findings already show.
And the other thing is, there were a lot of newer managers who did want to take part, but they're still in the process of completing fundraising, of actually making investments. It's still too early for a lot of them to secure any exits. So a number of them also said that it wasn't really going to be a meaningful participation at this stage, but definitely looking forward to participating in future surveys. Okay, good. I think that's all from my side. Thank you very much. Enjoy the economic overview and then the panel discussion. I'll see you on the Sky Deck.
Me? Perfect. So great. Am I supposed to come now with the bad news, right? But no, thank you, Gogana. I think it's a really interesting survey, and I really like the focus that has come in on ESG. I think the balance between making investment returns and also the broader contribution to this continent we live in, who's got lots of challenges and from social and environmental perspectives. So it's really nice to see that trend, particularly compared to the global environment. But yeah, so various studies highlight key factors that drive private equity into various countries. It's the typical factors linked to just general business environments in different countries, like shareholder protection, favorable tax environment, and so on. But the key factor really comes down to economic growth, and that is really what attracts and grows private equity and across countries. So, while there's lots of things I could be touching on from an economic perspective, particularly in these times, I'm just going to focus on economic growth and touch on the other kind of aspect that has been in front pages, for a long time now, inflation and interest rates. So, let's just start off, where were we? So, taking us back, we're time traveling to, the last quarter of last year. And we had, come off from, there was a little bit of euphoria, barring, of course, the tragic, human cost of COVID. Global economies in countries around the world had actually survived and bounced back better from the pandemic than initially anticipated. Demand was coming back strong, supply chains had recovered, and we felt we were in a pretty good space. But then in December 2021, and there's also this discussion around, inflation being transitory. Inflation is ramping up, that's normal. Following on from the pandemic, people are spending more, and it'll come back. It's transitory. And then around December 2021, central bankers thought, hang on, transitory is not quite the case. And that's when, the Fed started raising rates, and sort of markets, got a bit really cautious, saying, hang on, this recovery is maybe not as clear-cut as we thought, or going one direction. So this chart just highlights the forecasts for this year, for 2022, sitting at January, at the start of the year, essentially. So this was basically a time when we were just coming in from rising, COVID cases with Omicron, and there was this appreciation. Okay, it's going to be a stop-start recovery to the global economy, and then and then the war in Ukraine hit on the 24th of February. And economists, we went from being sort of para-epidemiologists to being, geostrategic experts and geopolitical experts. We are flexible like that. But and that takes us to where we are. So these are forecasts at September. So again, for 2022. And I've just compared here. So those blue dashes are the previous forecast, and just showing kind of the comparison here. And so we know the war in Ukraine has had this huge effect on the global economy, hitting supply chains, commodity markets, and no country has been untouched, but they have felt varying degrees of the impact, and some positive and some negative. So countries that have benefited have been the commodity exporters. So South Africa is a perfect case in point of that. So our mining companies have done extremely well, which has boosted our terms of trade. Our balance of payments looked fantastic, which has been great also for our fiscal situations. Our tax revenue came in far higher than anticipated. But then, on the other hand, countries who are net importers of commodities, so a lot of East Asian countries have been really hard hit. And then, but we see that actually the downgrades to the global economic outlook are largely sitting on the developed market side. And that's got to do with some of the factors I'll touch on in a bit. But really kind of where we're sitting is that the situation the outlook is not too different for us sitting in sub-Saharan Africa. It's come off a little bit, lower, but the outlook is kind of similar to where they started off this year, despite the situation changing so much. So, yeah, and then, just onto inflation. This, well, I'm not that old, but I hear this is like the 1970s, at least I know from books, the environment where we're sitting. And it's just interesting, we're seeing that the merged advanced economies are really bearing the brunt of this inflation crisis. So this is just an index of inflation for advanced economies in emerging markets, and indexed to the last quarter of 2019. So really seeing advanced economies hit super hard. I mean, this is not something that they've been used to. So if you think about the US or UK, who've been used to 2% inflation, suddenly, hitting double digits, this is a huge shock. And African economies, we are used to inflation. We are used to uncertainty. And so the relative impact of this high inflation environment has, let's say, well, you can't see it, it's not as detrimental as when you see it in the numbers. But still, we are seeing effects. So the main, let's say, concern from this is, the expenditure basket of African households. So 40% of households in Africa households spend 40% of their expenditure on food. And this is where inflation really hit hard. So from an inequality perspective, poverty, and knowing that a lot of people suffer from food insecurity, this is, makes consumers or people on the continent really vulnerable to high inflation. But this again has been really varied across the continent. So Zimbabwe, for example, has got the highest rate of food inflation in the world. It came in at 353%. Nigeria's inflation reached a 17-year high of 23% in August. South Africa's inflation has come off slightly off the boil, coming in, I think, 7.6% most recently. But this is all really driven by two items: food and transport. So other baskets, other consumer items have seen very mild or moderate growth in prices over the period. So clothing, communications, education, recreation, those kind of items have really not seen significant growth. Zambia is a really interesting one. They have bucked the trend of basically every other country in the world. Last year, their inflation rate was 24.4%, and this year they came in at 9.7%, their latest number. And that has really got to do with a lot of the positive economic strategies and sort of business-friendly environment that the government has instituted there. So that's quite an interesting case. So yeah, it's but I guess I think but there's also, so given all that bad news for many other countries, there's a bit of hope on the horizon. Food prices have been coming down since they peak in March of this year. So the UN's Food and Agricultural Organization has just seen a decline in food prices, every month since March, which is great. Oil prices have been also moderating, and that's also partly to do with fears of a recession, which I'll touch on later. So there is some hope that we are turning a corner on this inflation story. But prices, while they are fairly quick to come down, there is some to come up. There is some stickiness on the downside. So this whole inflation story has caused central bankers to really apply the handbrakes on easy monetary policy. And these two charts, so the one, it just compares interest rates, the most recent interest rates to the interest rates experienced a year ago. And again, we see developed economies have seen massive increases in interest rates. I mean, if you imagine if you're a homeowner in Canada, that kind of interest rate you're facing now compared to where you were a year ago is extreme. And then if we look on the side of emerging markets, we started raising rates earlier than a lot of the developed countries, and we've been able to raise rates generally more gradually. So the rates increases in the developed countries is stoking fears of a recession, which kind of leads to the outlook. But so for example, in South Africa, we'll find out tomorrow. But as we stand today, our interest rate we're not yet at the level before the pandemic hit. So we're still below pre-pandemic levels in terms of interest rates. But I imagine tomorrow we'll reach 6.25%. So that's still we are a very different situation than many of the developed countries. So in developed economies, I think the real risk from these higher rates comes into countries which have high levels of home ownership. So countries like Canada, Netherlands, the Nordic countries, there is some risk there in their housing markets. For the emerging markets, the main risk, or two main risks, are really that high interest rates in the US are going to weaken emerging market currencies, and that's also the US Fed is going to make its announcement today, and just really curious to see what the rand does. And the other risk is, emerging markets are highly indebted, and as interest rates rise elsewhere, it basically puts more pressure on the fiscal situation in these markets. Okay, so now where are we going to? I mean, there's this bowl of spaghetti, I guess, of economic and political risks coming in, and it's a lot to take in, and so many levers that could be pulled, and have very different results. So I think the most useful way to think about the way forward is not just thinking about a baseline view, but is to really think in terms of scenarios. So this is just an example of the scenarios put forward by Oxford Economics. They've put, scenarios: advanced economy recession, high inflation regime continuing in markets, gas rationing in Europe. And then on the positive side, they have a slower rate of policy tightening, which is probably seeming very, very unlikely. So, I guess, from this, what you can see is that a lot of the risks are way to the downside. The only really positive scenario is the slower policy tightening outlook. And also is that Africa is looking a lot better under all of these scenarios. So there is some positivity on that front. And tying back to my first point when I started, that private equity really depends on economic growth. I guess there is some potential for appetite for investment, towards the continent, as long as investors not just wanting to keep their dollars in the US in these times. But that's my story, and I'm really looking forward to hearing the panelists unpack all of these factors. Yeah, and any questions, I guess, if there's time. Yeah, perfect. Yeah. Mm. Yeah. Yes, I think that's the one key, I suppose, concern around a global economic growth perspective is what's happening in China. So even before the pandemic, China had seen slower rates of growth. It was just natural; they couldn't kind of keep up that momentum that they had for so many years. But what's really kind of added to their strain most recently is the continued lockdown. So they keep on shutting off entire cities, ports. So that is the one factor. And the other factor is they've got some issues in their investment. So investment has slowed a lot. There's concerns around the housing market there. So there's a lot of different factors that are slowing Chinese growth. And so, as you pointed out, the Chinese government actually opted to cut interest rates to try and boost the economy. And that's, so China's growth is one of the factors that are also pulling down global growth. Yeah. Yes.
I just want to know, has there any, the greatest risk of South Africa, has there been impacted in any of the growth forecasts in the coming years?
Yeah, I guess it depends on the forecaster. Some forecasters might have considered that. I guess there are also just other factors going in, and they might outweigh certain, load shedding, for example, is a critical one that has been priced into our forecasts for a long time. But I guess this new stage we're coming in with stage 6, extreme stage of load shedding is also something that's downgrading growth. So I guess it's all these relative. So these kind of things do factor in forecast development, but I guess it's really hard to identify like what proportion of the downgrade and so on would be attributed to that. Yeah. Great. I think you all are stupefied. Great. No, perfect. Thank you. Kate.
So thanks, Angelica, for, I guess, some silver lining, much more than I expected when I started today. It's great to see South Africa and Africa featuring much better than many parts of the world. Hopefully with all of us experiencing load shedding worse than it's been for many weeks and months, you at least can go out here with some positive to share, and also hopefully a lot of positives out of our private equity survey and what's happening in private equity. I'm going to be joined by 3 illustrious guests, really veterans, leaders in the sector. So I'm going to ask Mamedupe, Atta Capital CEO, Mike Donaldson, Corvest CEO, and Sia Ntlumayo, Vuna Partners founder and partner, to come up. So I know Shelley mentioned we're going to discuss the participants' views on 2021, but I'm really going to push them to share a bit more about 2021 was a while ago. So we're going to get their perspectives of what's happened then, but also what is happening in the industry now, what are they seeing in the market, to get a really fresh and current perspective of what's happening. We're going to start with some quick fire questions, make sure everyone's still awake. We are on the last journey before having drinks and enjoying the sky decks, but really want to get insights from people in the industry and really working in that. So I'm going to start 3 quick fire questions, one by one. I'll start from Mike and go across and then switch it around. What is your top priority, Mike, for RMB Corvest currently?
In one word?
One word, max 3 words.
Closing.
Closing. Great stuff. Mamedupe?
Long-term growth.
Okay, taking the 3 words.
Ours is closing fundraising.
All right. And I'm going to start with Mamedupe now. What is your number 1 talent priority?
So probably employee value proposition.
Go with it, yeah?
It's not one word, but our associate has just come back from maternity leave, so I just need to make sure that she's comfortable in the office.
The signs of a small and new fund manager. Every person down to the individual counts. Mike?
Experience.
Experience. All right, and then last ones here, we're going to start with you. Which sector do you see as the most exciting from the current investment opportunity?
It's not a sector, but it's a function, which is manufacturing. We're excited about manufacturing.
Great to hear. Mike?
So food and probably locally branded food and beverage.
Very interesting.
Yeah.
Madipe?
So on our end, I think most exciting sectors at the moment are energy and telecoms.
Great. Cool. I'm going to ask a couple more open and discussion questions to get into a bit of the meat of what's happening in the industry now. But given how much has changed since 2019 seems like a decade ago, and it's only 3 years ago, where, Mike, are you seeing the most change in your portfolio companies? R&B Corvest has a massive amount of portfolio companies. Where are you seeing the most change given we're getting into hopefully a more normal environment? I don't know if stage 6 load shedding can be viewed as normal, but it feels, given where we've been over the last 2.5 years with COVID and everything else, and supply chain and everything, and seeing South Africa better than globally, where are you seeing and focusing on change happening in your portfolio companies?
Yeah, Graham, so I think it's probably more, I guess, from COVID. I think a lot of those companies, portfolio companies, have built up a lot of cash. So I think there's a hell of a lot of cash washing around, which now competes with ourselves in terms of private equity. But I do think it is a bolt-on kind of theme that's happening. We've never seen it as much as we're seeing it now in the portfolio, where managers now are becoming M&A specialists, or they think they are, which is very dangerous. But they are. I think they're definitely taking more risk and looking at those bolt-ons a lot more carefully. Whereas in the past, we used to beg them to look at it and probably spend too much time trying to teach them, but we couldn't get them over the line. Whereas I find the engineers of this world today are prepared to take a little bit more risk.
That's great.
Yeah,
Positive
it's good and
news
bad.
to
But
hear.
yeah.
Cool. Madipe, in terms of a topic of change as coming on as CEO, I think early last year, I mean, what have been the areas you've focused on as a new CEO in ATA? Has there been a lot of change? I'd be interested to get your views and where you stand now, a couple of years in.
Yeah, I think from an ATA perspective, we find ourselves in a very interesting time, I guess, in our own life cycle. So we sit with a number of funds that are in different phases of their life cycles. So we have funds, a fund that's currently in exit mode, and we're essentially executing on that exit plan. And I think it's an interesting trade-off, I guess, between timing of exit and maximizing value, obviously, for investors. We have a fund that we're actively investing in at the moment. So there again, looking for the right deal. I think we started investing in that fund when we first closed in 2018. And I think we're probably nearing the end of our investment cycle there, and so probably have enough capital for probably one more transaction. But again, trying to find the right one, and with the various risks I think that were even brought about from an economics perspective, it's brought about, I guess, a different way of having to review portfolio companies, again, take into consideration what's going on from a future perspective. I think on a more global perspective, from a strategy perspective, from ATA's life, I think we are considering a lot more what we will look like going forward. We celebrate our 10 years actually this year as a company, and a lot of the strategic work that we're doing is what next for us, and how do we grow from where we are today.
Thanks, Madipe. See, as a founder of a new PE firm, but as someone who's been in the industry for quite a while, having that, let's call it, opportunity to start afresh with your own views, I mean, anything that strikes you of what you're doing in Vuna that's different to before?
Yeah, so Graham, so prior to starting up this firm with my partner in January 2020, we were part of a listed investment holding company. We're basically running away from fundraising, we're joining a company with a lot of capital on balance sheet, and we thought, yeah, we're in a good position, but yeah, unfortunately, it didn't last for us. I think, yeah, probably in those 2 or 3 years in the public markets, it was interesting where you're dealing with a lot of asset managers, institutional shareholders. They're always keen to meet with you, flying down to Cape Town, Ben, your people. And when you get there, they give you a hard time to tell you they're doing a terrible job in terms of protecting the share price. There's a huge discount to NAV. But on the other end, they're keen to find out what's happening in the business. There's a keen interest there. They're very responsive. And I guess fundraising, it is a bit more difficult. The cycle is a lot longer. And pension funds and fund of funds are under a lot of pressure in terms of responding to the opportunity in the market. So you do find it a bit frustrating that you don't get responses quick enough, but you have to be a bit patient. So there's a lot of churning good news stories. So every time there's a deal that's been concluded or there's something exciting on the pipeline, an ESG report, you want to bomb that out as quickly as possible to try and get in front of people's faces. But that's just a reality where we find ourselves that there's a small universe of people allocating capital. And so I guess as a new fund manager, you need to try and stack up the good news to try and get in front of the curve.
Maybe going on to that topic of fundraising, given we saw it decline a bit from 2020 to 21, you've been in the market for a while. What are the sort of key things that LPs are focusing on that maybe they weren't as big topics, say, pre-COVID? I mean, we hear a lot about ESG and talent. From a South African perspective, speaking to LPs, what are the sort of big topics that you, I guess, having to think about?
Yeah, so maybe I'll just cover maybe two themes, and then maybe the other guys can cover the rest. But I think because of the lever shifting towards investors in terms of influence and power, conversation around fees, conversations around who's in the team, who's driving the strategy, conversations about shareholding in fund managers. A lot of those discussions you could kind of push out and have probably a middle ground approach. But I think investors are a lot more firmer now. Some of it has been driven by some of the failures that we've seen around in the continent, or maybe not the continent, but rather maybe, let's say, in emerging markets. So governance has become very important. And so I think that particular theme has come a bit stronger in the last while. And then I think although the data is not quite showing it, but I think there's a bigger interest in terms of managers that have got clear strategies or clear themes and clear sectors that they want to focus on. I think they want to see a demonstrable track record in specific sectors, and also where you're going to allocate that capital. So they want to be aligned with your strategy. So I'll probably say those are the two things that are standing out during this fundraising cycle.
Cool, thanks. Yeah. Mambadupe, maybe you mentioned about evaluating your strategies and where do you want to be in 5 years, 10 years time? I mean, when you think about preparing maybe to go fundraising again, any sort of views on that sort of diversification? We saw, it's not quite as high on local players' agenda in terms of diversifying into real assets to private credit. I mean, any other topics that you feel you're having to prepare for over the next year or two before you go out to market?
You can't say retirement, eh?
Yeah, I think we're definitely, we're probably on the road again in the next 18 months or so. So there's definitely a lot of work that's being prepared around our fundraising strategy, and I guess even a value proposition. Specifically in an ever-changing and ever-competitive market, I think there's a whole lot more of us who are fundraising at the moment. And so I think, as Sia is saying, that I think our story has to be very clear around what we are selling. I think in terms of product and what we're definitely getting from LPs as we're having conversations now is really around this impact space. I think there's a lot more, even from a selling of a private equity perspective, where we need to start selling not so much, I guess, the returns, but also, what is private equity doing and selling our story from an impact perspective. So probably a lot more work that's going to have to be done in terms of, having baseline data, measuring, monitoring, when we start and, what we do when we exit. I think there is a lot more of that in terms of the questions we're being asked. Obviously, ESG probably comes up on the survey. For me, I think it's become a ticket to the game. I think we all have to do it and sell the benefits around that. And it has really become part of our investment strategy as we do financial due diligence, tax, legal. ESG becomes another one that we do from the beginning.
And Mike, obviously you don't have to do all the road shows across the world, across South Africa.
Thank God.
But as a captive,
You guys need a medal.
as a captive, and there are many captives in South Africa, I mean, are the demands of your, I guess, stakeholders and shareholders, have they changed as well as corporate South Africa and requiring more on social impact, on other things other than pure, show me the return on investment?
No, I mean, I think it's definitely coming. So I think we'd be crazy to think you have to tick that box. And I think you've got to kind of demonstrate to the portfolio guys that there is benefit. And I think they're seeing it. So I don't think it's not an ask. I think it's going to be an easy sell. But yeah, with a captive, I think it's no easier. Our LPs are all concentrated in one, and sometimes it's one person. So I think for us, it's very much about we've got to keep churning the portfolio. If we want to keep tapping that LP, we've got to demonstrate we can sell. And I think the old age of just building an industrial holding company, disguising it as PE is, I think, a thing of the past. So we've got to churn. And I think ESG will be part of that. But it's certainly, at the moment, it's not the first and foremost.
And maybe let's switch on to that important topic of exits, of churn and returning. I mean, your view of sort of some of the top things that you're focusing on to be able to exit, obviously maybe not under the same time pressure from, having to raise a new fund and exit at a non-optimal time, but as you say, you need that churn to show returns back to your shareholders. I mean, a couple of the things that you may be looking at to make sure that those companies are then ready when the opportunity arises?
Yeah, I mean, and again, I think in the past you can get lazy. I think with a big portfolio, and I think PE is all about deals, closing, as we've all talked about. Everyone wants to just keep doing deals, but unfortunately the selling is, as we say, it's much harder than the buying. Anyone can pay 10 times EBITDA and you'll build a very quick portfolio. So I think, yeah, we've got to be more disciplined, and I think we've got to go to market and we've got to be less greedy. And I think where there's a realistic buy on the other side, there's not necessarily, sometimes your first offer is your best offer. And I think we've probably missed that too many times. And I think we're all guilty of that. So a lot of deals have been going around in the last 24 months. 90% of them are not closing. There's a lot of talk. We've lost the international buyers. We've lost the big buyers like there used to be Carlyle, used to be Abraj. We need to find those bigger players have to come back. Otherwise, I think we're all going to be challenged with, 5-10 years' time, those bigger companies you're not going to sell. So I think it's just more discipline and less greed.
Mamadipa, you also, as you mentioned earlier, on I guess, the earlier fund, not the recent one where you're deploying. I mean, anything to add there that you as a team, and maybe just broader in the industry, that there needs to be further focus in order to achieve those exits? Anything you as a team are thinking about and trying to do better?
I think on our side, having learned the lessons as we're exiting the portfolio now, is probably spending a bit more time at the beginning of your investment, figuring out and analyzing what your potential exit is, and probably even structuring around it for where you can. So I guess as you go and you put in your investment thesis, you do talk about what your potential exit is, but it doesn't always materialize. And I think we probably have to be more in control of that process around, what is the exit universe? If you're saying management is going to be a potential exit, how are they going to fund their exit? You probably need to start spending a lot more time analyzing that and structuring and upfront making sure that exit is guaranteed to a certain extent. It was interesting, I guess, coming out of the survey that if you look at the historical years, I think 3 years back, there's more trade buyers, and I think it probably talks to the value also, Gagana, around what's gone or happened to the exit values. I think from a trade buyer perspective, I think, Mike, you also touched on it, it's probably reduced a bit more in terms of our potential for trade buyer exits. A lot more deals are circulating around the private equity players, and I think probably the most likely scenario around exit, because it is a market that is active, it's a market that has capital, and can probably execute quite quickly. I think we probably do need to be a bit more sober. Hopefully the private equity players are a bit more sober about the valuations, because you then have to look forward in terms of how are you going to exit and at what valuation. So I think that's probably where we need to go to. There's a lot more opportunity around exiting of transactions, just looking at ourselves as private equity players, and then obviously making sure that there is enough runway in that asset for the next player, I guess, as they try and make their return profile.
Maybe one other topic on this is the involvement of the entrepreneurs and the management teams. I think in preparation for this session, Mike, you had mentioned one of your key focuses is on those management teams that you're partnering with. What are those discussions with, given quite a lot of people at that sort of senior management level looking to retire elsewhere, this level 6 load shedding not helping. Hopefully they get to see some of this macro stuff that actually South Africa now and again is a whole lot better than elsewhere. I mean, any views on getting that management alignment and succession planning? Because I guess selling a business to a financial sponsor, at least without that management team, is almost a non-starter. Your thoughts there?
Yeah, so I mean, I think in the old days where you did it at MBO, everyone gets the equity, you wait 6 years, you sell it, those guys are going to make a lot of money and they're going to reinvest. That was simple. I think that where we find ourselves now is that most of the management teams are old. They really are. I mean, I think COVID's added another 3 years to that debate. So now they're 3 years older. So I think where we sit now, you've got a lot of guys in their sort of 60s. And 50s, but 60, and it's old. To try and do an MBO or an expansion capital with a team in their 60s, they're not going to reinvest. And any private equity team in this room would say, well, I want your team to reinvest, Mike. And the first thing the team says, no, we want to take our money to London. So that blows us out the water. So now you can't even get out of the starting block. So I think we've just got to be more disciplined that we don't wait for that 6-year period. After second and third year, we've got to try and build a succession and bring in guys, whether it's a different equity layer or a different sort of methodology, how to incentivize them, but lock them in. But we really are. I mean, I think we're losing hand over fist in terms of senior, experienced engineers. They've been in the game for 30, 40 years. We're not finding the younger guys, black sort of professionals coming through in that market. And it's going to be very hard. And we just don't have the skills. So I think we've all got to think out the box. How do we lock in more entrepreneurs? And it's not just the portfolio, it's within the private equity teams. UK, Australia is looking very attractive for PE. And how do you lock those individuals in? So there's no magic bullet. I mean, I don't know what the answer is to Boris.
So you mentioned key man risk, you deploying into new investments. I mean, your thoughts on looking at who you're partnering with and how you manage risk like this on new investments, hopefully looking 4 or 5 years out to achieving successful exits?
Yeah, Graham, so we do try and spend, I mean, it's been difficult during the pandemic, but we try to spend a lot of time trying to grow our universe of executives that have done well in corporates and are looking for the next thing, are willing to take some money off the table and reinvest in a private business. So we actually spend a lot of time as a team to try and build a network. It might not be able to execute it immediately, but we're fortunate that it did pan out on our second deal where we managed to get a guy who was ex-Nampak and other beverages opportunity to come and run our business. And for us, it was a great opportunity to bring in William Kabela in our business. But that's what we try to do is try to build a pipeline. We also like to take control in our investee companies so that we can actually have that succession conversation a lot sooner. It's a bit difficult if you've got 25% shareholding and trying to tell a 75% shareholder, listen, you need to step back. It's just not going to work. But if you've got a voice, but also a little bit of rights as well to try and push that conversation, it does help. Because, some guys, they like the dividends. They like that there's another shareholder that is taking some of the responsibility and they actually want to carry on. But unfortunately, it does depress their exit value. So you do need a bit of control to fast-track the succession debate.
Cool, thanks. Maybe I'm going to transition to the investment opportunities and where you're seeing opportunities. Talked about maybe sectors earlier, but the type of investment opportunities that maybe you're seeing more of now. Mike, any thoughts on the sort of current environment right now? Are we going to hopefully see uptick of investments after sort of flattish 2020-21, or what's your views?
I mean, I think definitely. I think we can all answer that quite simply. I think 22 is definitely better than 21, which was definitely better than 20, which wasn't as good as 19. But so I think we're definitely getting back to the sort of era of 19. I think there's a lot of transactions on the go, and I think a lot of them are closing, which I think is promising. So I think this Ukraine-Russia war has definitely played into South Africa's hands a little from a commodity point of view. I think our mining assets and suppliers are doing well, and there's a lot of activity there. So I think those transactions will continue. And I think this whole supply chain issue has also driven a few transactions where all of a sudden South Africa is the place to invest. I think local is becoming better. You talk to all the big retailers, talk to a lot of local major conglomerates. They want to get supply from South Africa. So I think those old international distribution businesses and hubs, I think, are finding it very challenging. So I think the deals are there. The deals are definitely, South Africa's, I think, well placed with all the crisis going around the world. Private equity has to be the best place to be positioned, right in SA. So I do think 22 is going to be, I think it's going to be a good year. 23, unfortunately, I think we might feel the lag of what we're seeing overseas hit us next year. But I think 22 I'd be very surprised if the 22 numbers aren't significantly better with it than what we've seen today.
Thanks, Mike. Mamedupe or Sia, either of you, any thoughts of where you're seeing investment opportunities, the type of investment opportunities?
Yeah, I think on our end, there's a lot of probably traditional sectors that have primarily because of COVID transformed, I guess, and moved to maybe online platforms or some digitization. So we're seeing a lot of that, some in retail, some in the education space, payment platforms, etc. So seeing a lot of opportunity there as companies have, transformed themselves, coming out of, sustaining themselves in the COVID world. They are a bit more difficult to be honest, value and price, and I think we spend a lot of time trying to understand those. I guess as people start bringing in the tech angle and the increasing margins as you go. Outside of that, as I mentioned earlier, I think for us, given that our portfolio is predominantly on the telecoms and energy side, we're seeing a lot of opportunities coming out of there, coming out of legislation, I guess, as things are opening up and allowing more players into the market. We're seeing opportunities there. So it is a mixed bag. We're seeing a lot of transactions. I think Mike was talking about management teams, etc. A lot of transactions with 100% sale, obviously, as people are externalizing capital and moving overseas, etc., which obviously brings in their own, risk, I guess, from our perspective, as we want to have management teams invested with us. So it's interesting to see how that ends and how we work around that.
Yeah, Graham. So we also aspire to be involved in these attractive industries, but we've got a small fund. So your first investment is just a foot in the door, and then thereafter guys are looking for growth capital. They want to dig trenches for fiber, and we just don't have the capital. We want to build hospitals. It's a great impact story, but we just can't. But where we're focusing is something that Mike touched on, which is your manufacturing businesses. because of global supply chains, a lot of companies or a lot of customers or some of your peers that can't import anymore. It just takes too long to bring something from China. It's just a lot more expensive. And then government, DTI is doing a lot to try and support, insulate our local manufacturing by putting up tariffs. So it's becoming a bit more expensive to import a lot of products. So you're finding a lot of local manufacturing businesses that are actually now finding a market for themselves, whether it's from a timber point of view or metals. It's just a lot cheaper to source from a local manufacturer. So we're finding a lot of joy or finding a lot of opportunities in those kind of businesses. Obviously, they need to sustain themselves without any tariff protection and the like, so they need to be efficient. And it's not helping that ESCOM is not doing their bits. That's a bit of a challenge for a lot of companies that they need sustainable power and they can't rely on renewables. I think that's a challenge around manufacturing, but we definitely like manufacturing. I think it's a great space to be in right now.
Cool. So I'm definitely, while there's lots of challenges, sounds like there's definitely green shoots, silver lining around. It's just digging hard to find all those, but definitely sounds like quite a bit of opportunities arising. Maybe just because I think everyone is keen to have a drink and enjoy outside as well. In closing, I'm going to ask each of you the same question, but just what is your recommendation to PE firms in Southern Africa of the one or two things you believe we really need to get right over the next year or so to really, I guess, bolster the sector? And maybe I'll start from that side this time and start with Sia and end in with Mike.
Yeah, Graham, so I think sitting in the public space for a short period of time and being very close to your investors and the people allocating capital, discounts to NAV returns are a very big discussion, and it's not a delay. If people are not happy with what they're seeing, it reflects on your share price. So that was a very brutal and honest experience for us, and so bringing it into our space in the private markets is something that we really need to think about. Is that I think we have underperformed for a long period of time, in particular in South Africa, relative to global PE. So I think this time around, a lot of pension funds have been putting capital into the space in terms of replacing the DFIs and other global investors. We need to deliver those returns. Unfortunately, we can't go another wave of moderate returns or underperforming the public markets. We need to deliver.
Thanks, yeah.
Yeah, I think on my end, touching on what Sia mentioned, yes, there's a return, but I think as we go and try get a diversified set of investors and educating more, I guess the pension fund space is a space that we are actively engaging. I think we probably need to tell the story a bit better. I don't think PE tells their story really well around the benefits of private equity outside of, I guess, returns, which are not working with us at the moment. So I think we do need to talk about the impact that we're making as private equity managers and celebrate the successes of investments where private equity has been involved. I think it would be remiss of me not to talk about the diversity topic and transformation. I think if you look at the survey, we still have less than 20% of women in front office in private equity. And as much as people are saying that they want to focus more on diversity and bringing in, I guess, a more diverse lot of people into private equity, I think it goes beyond that. We probably then have to look to what we then do once you've then attracted that talent, from a policies perspective, from a culture perspective. For me, I guess even as an experience perspective, from a personal experience, the market is still largely untransformed. I think there are a lot of unconscious and conscious biases that still happen in these spaces. And so how do we support, this diverse talent that we're trying to attract into private equity and then make sure that we're retaining them? So I think, yeah, that's something that we do need to work a whole lot more on.
Thanks, Mama.
Yeah, obviously different tactics. I think if we want to make the industry better, I think there's probably too many funds around. And again, I go through that Savca handbook. There are thousands of names in there with a little bit of money being raised from a lot of different parties. And I really do think if we want to compete on a global scale, the teams and some of these funds have to join up. And I think where you start bulking up, where you've got more experience in the teams, you've got a bigger allocation of capital, then you can compete properly. And really to compete with the smaller funds, we all compete. I mean, a lot of the funds you see, they're almost killing each other in terms of pricing, and because there is a lot of sort of selling between funds. And I think the last thing we want to do is kill each other. We want trade and international to come in, and we can pass these things at these 10 times EBITDA businesses. And I do think there's just too many funds with too many people running around, where if you had half the number of sort of teams with double the capital, I think you could really be a proper player. And then obviously to make it better, RMB keeps reminding us about the two, what's it, Warren Buffett rules. First rule is don't lose money. And the second rule is don't forget the first rule. So if we don't lose money, I think South Africa I think we've got a long way to go to catch up to sort of Europe and PE funds. But, we are very diverse. I think that's the number one thing, yeah. But yeah.
Thanks, Mike. Maybe I can ask everyone to give our illustrious guests and speakers a great hand. I don't know if we're allowed to take one or two questions. If anyone has any burning questions, we obviously feel free to ask questions over drinks as well. I see we have got a few questions wanted.
Can I ask two? So first one is, I guess I'm curious, right? The JC, I suppose, constituency has been declining. And in terms of exits, I mean, private equity used to be the natural feeder. It doesn't come up in the data, it doesn't come up in the discourse, so I'm curious why. Because I think Discam was the last private gone public that I can remember. That's one. And then two, I guess, is related to the comment just made now to say, with the changes of Regulation 28, clearly we expect a lot of capital to hit private equity. And then if you listen to Mame's point to say, if I listen to private equity, we seem to obsess around the entry point and the exit point. And we never talk about in between, right? I think it was only mentioned once to talk about value creation in a discourse. But if you talk value creation and you talk private equity, valuation seems to be like a sticking point. So I'm just curious to find out, how are you thinking about the industry more or less standardizing valuation so that there's transparency, so that investors can look at the incremental value increase pre-exit, I suppose?
So maybe I'll answer the first question on exits by IPO. I mean, having done the study for the last 2 years and previously, as you said, there hasn't been exits by IPO. I mean, since Discam, and there was maybe a very small PE shareholder in there. I think the reality is it's very challenging to do an IPO in South Africa, and I think even globally, outside of a handful of markets like US, Israel, and a handful, the listed markets just have declined across the world. And so I guess the private equity and broader the private capital market, because outside of private equity, I think the family offices and other private capital is where I guess there's been more interest in achieving exits, but also a model that works for everyone. Not to say that IPO is off the table totally. Pre-Ukraine, Russia, I think there were 3 PE-backed IPOs potentially on the table. But that challenge of an IPO window and something like COVID or Ukraine happening makes it very challenging, I guess, particularly for private equity shareholders and LPs. But maybe on the value creation, it's a good question and a topic. Welcome any thoughts.
I question whether we've got the teams to actually do that. And the reason I say that is probably 99% of all professionals in South Africa in PE are financial. There's very few specialist engineers, doctors who are in those teams. Whereas if you go to the US and you go to the UK, you will find those teams it'll be a pharmaceutical PE business and they will have pharmacists. They can get stuck in, they can roll up their sleeves. You know, when PE firms tell people, management teams, I'm going to add value and I get nervous. And generally it ends in tears. Not always, but I think you must know what you're good at. And I think PE in South Africa is very sophisticated, but very financially driven. And the metrics is all about you buy right, and if you sell right, you'll do well and leverage the hell out of it in the meantime. But it's an easy way to make money. But if you're backing yourself to change a management team, add value, it's very, very hard. And I just don't think we have the teams and the professionals to do it, not yet. I think we're going to evolve there. But I don't know.
Ben, on IPOs, I remember as an associate, exits, IPO was the first thing that you used to put in your discussion paper or transaction memorandum, but over a period of time, you realize that actually that's not going to work. And I think there are a couple of things in South Africa that make it more challenging. One is on the buyer side, in terms of your asset managers, the one that get a story is in this company that's listing. Why are you listing? Is it because there will be further capital that's going to be required? And if the story is just to exit a PE player, then it just becomes even more difficult to back that story, as in why are we giving these guys an exit, and what happens with this particular share that's going to be held by an entrepreneur while the PE shop exits. And so then they'll ask you to retain some script, and then you hold on to these shares for another 2 or 3 years, and your exit is meant to be 5 years, but now it's 7 years because you're now waiting for that date to actually go and dump these shares on the JSE. So I think it's got its challenges in terms of telling an exit story, or rather a story for buyers. And then from a value add, I think I agree with Mike, a lot of CAs and investment bankers. But there are a couple of things that I think we can do, and we do, which is there's some repeatable experiences that we have which entrepreneurs don't have. I think entrepreneurs are very good at engaging with the particular clients and know the particular market, but there's some things that they've never done before, and I think they need somebody who's had that experience in previous sectors or previous organizations similar to theirs. So small things like business acquisition. Some of these guys are not strategic about how they think about getting new clients, and it's quite easy to say, listen, in this aligned industry, we're invested and we know all of these players. Why don't you actually expand your services to these particular sectors? You've never had ISO or SABS accreditation. You don't even know where to start. Actually, we've done it in a previous organization. So there's some things which are a bit repeatable, regardless of the sector, that I think we can add to these businesses. And then as a banker, Mike, this is your space, which is trade finance, cleaning up a balance sheets, which, I mean, it does add some value, and certainly it gives the company a bit of a headroom or space to grow a bit faster. But I do agree that bringing in a group of Bain and McKinsey staff, I'm sorry if there's any PE shops that have got value adds teams, yeah, I'm a bit suspicious of those. But I think if you've worked in aligned industries or owned similar assets, I think there's some things that you can actually share with the entrepreneur to help them with their growth.
Yeah, I mean, I can add to that, and maybe a different view. I think maybe value add does speak to the composition of our teams also, you know, in terms of who do we have on there. And when I sit on the board, I'm not a CA. When I sit on the board of a portfolio company, I'd like to believe that from a diversity perspective and from a skill set perspective, I'm probably bringing in something different from a typical PE player. I think another thing that we tend to look at, I think we sit with a portfolio of over 20 companies at the moment, and from a value add perspective is cross-selling, I guess, against portfolio companies. So essentially being able to introduce new business to other portfolio companies that sit in our structures. We're also helping out from the perspective of building platforms. I think there are portfolio companies who are looking at their value chain and trying to build there, and we're helping them in terms of those acquisitions, for instance, and also even adjacent markets where they can also bolt on acquisitions there. So I think there is ways to do it. It doesn't necessarily mean it's a McKinsey team, but I think there are ways, and I think we're being forced to do it, to be honest, because I think the financial bit and engineering can only do so much. And so we do need to then do a whole lot more from a portfolio company management perspective in order to make sure that the assets that we're leaving are probably better than when we entered.
One more question there. Yeah, go for it.
Just wanted to ask, with regards to what we saw in the non-individual to investors, that declining over time, what impact on the talent you're able to attract, as you know, that's a key part I think in the private equity side is being able to share in that. And two, with regards to Jennifer mentioned around, the future looking a bit brighter, the SA. In most of us, the lived out experience is not that we're a lot more anxious. And I just imagine you might be in the same boat. I'm not sure, but if you are, what impact does that actually have on you going to office and trying to either buy or sell the business? What impact is your lived out experience having on just how you look at business reputation?
Go for it, yeah.
On exits, you're absolutely right. Especially on the pension funds, you go to them where they've had some exposure to private equity. They say, listen, actually, there's some guys that have raised larger funds and they go back to the same investors and they say, listen, we're now on funds 2 or fund 3, and they tell them, listen, forget about it. You need to go and return some of this capital that you've invested. All of these portfolio companies, you can't be amassing these deals. And then I guess on another spectrum is that pension funds have been under a lot of pressure. So I'm actually surprised that that decline from a fundraising point of view hasn't been that extensive, because there's been a lot of withdrawals. Either people have fatalities or people have passed away from COVID, and those are withdrawals from pension funds. People are leaving the country, so those are withdrawals from pension funds. And then we also, as an asset class, we're fighting against alternative investment products like your index funds. So a lot of clients are saying, or beneficiaries or people saving are saying, listen, I want to reduce my fees. Put me in an index fund. Don't put me in an alternative, even though these guys are telling me that through a discretionary mandate they can generate higher funds. So we are fighting with a declining pool of capital because of all of those other reasons, and it is having an impact on our ability to also return some capital. But I think it's something that we need to work very hard on the return of capital.
I think from personal experience, going into the market trying to sell a fund 4, we've been told, can you show us that you can exit first? So we definitely need to exit our portfolio. And also there are investors who are effectively saying, give us the money and we'll put it in your next fund. So I guess, again, forcing us to exit. So it definitely does impact our ability to raise capital going forward. On the talent side, I think you raised something that I'm also reflecting on a whole lot more. I do believe that PE is probably a very difficult model to sell to younger members. We're seeing a lot of, I guess, attrition just even from an associate analyst perspective, because at the end of the day, they're probably growing, I guess, even as younger in their lives, I think, in terms of getting married and buying cars and houses, etc. And I guess we can compete from a cost to company perspective, but we definitely can't compete in terms of banking bonuses and things like that. And we're selling carried interest, which is a long-term, I guess, proposition. And from that perspective, I think it's tough to sell. And I think that value proposition that I was talking about earlier is probably what we think about a lot in terms of how do we retain staff and make sure that they can see this carried interest but still want to stay in the short term. So I think it is tough. It is difficult to sell.
No, I mean, I think it's a great question in terms of the anxiety. I mean, we have it constantly in our bloody team, and it depends when you came in. If you came in last year, you're sitting very pretty because the world is looking, or South Africa PE is looking better. If you came in 4 years ago, you were probably underwater. And if you came in 7 years ago, you're absolutely fine. Luckily, I joined 18 years ago, so I've seen it all. The first 4 years, you're making money. By your 7th year, you're underwater, and you think, I've lost 7 years or 8 years of my life. By 10 years, it starts going above water, and it does this. And I think just to, and we keep, if you go back 18 years or 20 years, I think you'll find all private equity individuals, they've got through the worst of it, and there is light at the end of the tunnel. And it does make sense, and it's probably the best career you can ever possibly imagine. And it really does. It surpasses anything from the daily work that we do, and the rewards. I think it pays off, but it takes 20 years. If people don't have 20 years in them, it's definitely the wrong career. But if you know you're in it for 20 years, I think you can pack away all your anxieties. You know, it'll be good. But don't try and look at an NAV sheet over a 2-3 year period, because that can look very, very scary. But bank on 20 years. It's very, very hard not to get it right over 20 years. You just got to do more right than wrong. So you're going to make mistakes, but I would say 70% you're going to get right. You know, it's a pretty good gambling record. So, you know.
Cool, I'm going to leave it there. And now you can clap hands for the speakers. Please don't run away. There are drinks and some eats served outside and enjoy the deck outside. And look forward to catching up and speaking with many of you that we are not the other side of a computer screen. We're right here.